All right. Hello, everyone. Ryan Allis with SaaSRise. We'll be getting started here in about 30 seconds. We're going to be doing a webinar today on how to sell your SaaS company. We've got four fantastic guests, which I'll be introducing here once we start, who are going to be talking about how to prepare for and execute a sale transaction for selling your SaaS company. This particular webinar is focused on firms that are between 1 million and 10 million in ARR. So we'll be getting started here in just a moment. We'll be recording this today and sending it around to all of our members. And this is a webinar that is just for the members of the SaaSRise community. So thank you for being part of the SaaSRise community. We're up to 20 attendees so far, plus the 6 of us. So with that, we'll get started here. All right, I'm going to share my screen to introduce everybody and share their bios, and then we'll have everyone say hello after that, and then we'll go through some questions. Throughout the webinar today, if you have questions as an attendee, feel free to put those questions in the chat window or in the Q&A, and we'll be sure to go through them. So with that, I'm going to start sharing a couple slides to provide just some brief introduction to the webinar, and then we'll open it up to our panelists today. So today's webinar is how to sell your SaaS company for firms with 1 million to 10 million in ARR. I'm the webinar host along with Salman, who's our head of member success. My background was building a company for 10 years called iContact. We got that to 50 million ARR. And then we sold that in 2012 for $169 million. We did not use an investment bank or M&A advisor for that particular transaction, but earlier when we did our Series B, we worked with Allen & Company, and prior to that, worked with Montgomery & Company to do those transactions. We raised about 50 million in venture capital between primary and secondary capital, and we ended up having a good exit. And then the last 10 years, I've been helping B2B SaaS companies scale up revenue and have successful exits. So that's what we're talking about today, how to have successful exits. I'm joined today by 4 wonderful panelists: Okan Inaltay from ComCap, Juan Ignacio García from Boopos, Khaled Azar from Livmo, and Marcin Majewski from Aventis Advisors. All of these gentlemen have been very helpful to us with data, with research, and understanding what's happening in the SaaS field. I'm going to skip ahead to just a couple of slides that we'll probably talk about later here. I'll just share with you 3 slides here of just some data. We are on track for a record year in terms of the number of SaaS M&A deals. We peaked during the COVID time, about 2,100 deals in 2022. But if you just take the Q3 2024 and annualize it, we'll hit about 2,300 SaaS M&A deals this year. So if you think about that, every single day, 7 or 8 SaaS M&A deals are closing. Any single weekday, maybe about 10 SaaS M&A deals are closing. So it's a lot. And you want to have good advisors helping you. This data point from Software Equity Group shows some average M&A and median M&A multiples for SaaS companies. Anywhere from about 4 to 5x is either median or average for SaaS M&A deals. There's a lot that can make that go lower and a lot that can make that go higher, which we'll talk about today. And then median EBITDA multiples, roughly around anywhere from 15 to 30x is what we're seeing for median EBITDA multiples for SaaS M&A deals. Around 22x was average in 2023. So with that data, we'll talk more about how to sell your SaaS firm. I'm going to bring each of these panelists into the room, and I'm going to have them introduce themselves. So I'll start today with Okan. If you want to speak for 30, 60 seconds and introduce yourself and your firm, and then we'll have each of us do that.
Sounds good. Thanks, Ryan. Thanks for having us. Hello, everyone. Good morning or good afternoon, depending on where you're joining from. My name is Okan Inaltay. I head up the SaaS franchise here at ComCap. We are a San Francisco-based, software-focused investment bank. We have about 40 people globally, and we specialize on kind of both sell-side and buy-side M&A and growth capital raises. I've been doing technology-focused investment banking for the past 10 plus years, and I'm joining you from San Francisco. Great to meet everyone.
Great to have you, Okan. We'll go next to Khaled.
Thank you. Thank you for having me. Hi, everybody. So I am a tech entrepreneur turned M&A. I spent the first 24 years building digital businesses, including a couple of SaaS. I've sold SaaS, bought SaaS, and decided to enter into the M&A space for technical and product founders, so SaaS and other digital companies. We generally deal with companies between 2 to about 50 million in revenue. And yeah, my goal is to educate as well as represent founders and owners on their path to an exit.
It's wonderful to have you here, Khaled. We'll go next to Juan Ignacio García.
Yeah, I'm Juan. I started my career as an investment banker and private equity investor. I did that for like 10 years. Then I moved on to found two subsequent businesses. One of them was really successful and grew up to 1 billion. The other one didn't do so well. And now I'm back into the investment banking world, closing the loop since a couple of years ago. So we help tech businesses from both Europe and the US get sold. Businesses worth between 10 and 50 million. That's a typical sweet spot for EV. Anywhere, I mean, around SaaS and software is what we are knowledgeable of. And again, the cross-border connections is perhaps our most valuable assets and all the network that we have in the software space in both sides of the Atlantic.
Well, wonderful to have you here. Congrats on all the success with Boopos that you're having, and grateful to have you on the panel today. Lastly, we'll go to Marcin Majewski with Aventis Advisors.
Hi, hello everyone. I'm really happy to be here. And congrats on, first of all, being in SaaS, which is great industry, and embarking on this learning journey with SaaSRise. We're really happy to be part of being able to contribute a bit. Myself, I've been in M&A for 20 years, so this is pretty much all I've been doing. I'm really fond of helping entrepreneurs make the best decisions that not only relate to their business, but their life as well. I have a small M&A boutique out of Poland. We're a team of 5, and most of the stuff we do is technology, and in particular, software, of course.
Well, wonderful to have you, Marcin. I'm going to be posting everyone's bio here in the chat window to everyone over the next few seconds. Feel free to take a look at those, and throughout this webinar, please do take a moment to check out the websites for ComCap and Boopos and Livmo and Aventis. We'll be putting them in the chat window as well. What I want to do now is go on to some questions that we have. And, you know, our goal today in this webinar, we've got 50, let's see how many, 51 attendees right now. So we've got a good sized group here. We want to talk about how to prepare for selling your SaaS company and how to optimize the outcome. And I'm going to pull up one slide here. These are the questions that we're going to be talking through here over the next 45 minutes or so. So we're going to talk through, you know, is it a good time to sell a SaaS company? How is the market for SaaS M&A deals compared to a year ago? What's the range of revenue multiples you're seeing in SaaS right now? How do you prepare to sell if you want to sell 12 to 24 months from now? If you're actually ready now to start the process of a sale, what should you do to get the best outcome? And so these are some of the questions we're going to talk through here. And I'm just going to call on the group to share their experience. Salman, if you could post the websites for all 4 of our panelists in the chat window, and we'll get going. So I'm going to start with you, Okan, to get your perspective here. Is 2025 a good time to sell a SaaS company? Let's talk about that question as a group to start.
Thanks, Ryan. Yes, certainly 2025 is projected to be, as you highlighted at the top of the meeting, a record year for SaaS M&A. That's what the Q3 of 2024 and Q4 of 2024 trends are indicating to be in terms of the level of activity and the appetite from both strategic players as well as, and very importantly, private equity players who are very active and interested in the kind of SaaS sector from a platform acquisition point of view. Economic conditions are favorable, like interest rates are relatively low. The new administration in the US is kind of, they have a pro-merger stance towards M&A, and public valuations have also improved, not to the kind of levels at their peak in the last 5 years, which was kind of somewhere in 2022, but kind of when we look at a 5-year average, we see a good kind of close to that average, or some cohorts beating that average. So kind of my view is definitely 2025 is going to be a good year for SaaS M&A.
Thanks for sharing that. Khaled, I'll ask a similar question. How is your take on deal volume now versus a year ago? What are you seeing? Do you agree it's a good time to sell?
Yeah, I do agree it's a good time to sell, and I tend to try to give these answers as it relates to the size of the business. Being in the space, we get a lot of data that really deals with much bigger transactions. The smaller transactions are hard to find data on. And so I've been sort of digging deep over the last couple of months on businesses between about, $1 million in ARR to 5 million. So that's, by the way, anybody that's gotten to 1 million in ARR, kudos to you. That is still very, very hard work. I think that goes undersaid. But that being said, it's a good time to sell. Yes. For the general market, the answer is yes. Once you start to go into the nuance of every company, that answer could be different. But for the most part, it is very much a seller's market right now.
Okay, thanks for sharing that. And Juan Ignacio, what are you seeing in the market? What are the trends that you're seeing in this, 1 to 10 million ARR SaaS range?
I generally agree with Khaled and Okan. I think this is definitely a seller's market. We're seeing obviously the aggregators and the financial investors and the holdcos coming in, and a lot of new ones are being formed every time. People that are leaving KKR and Blackstone and so on to start their own holdco and buy SaaS businesses. But what's interesting also is that we speak a lot to big corporates, and they're looking to acquire smaller assets now because they feel that the larger M&A deals are perhaps very competitive, and so it's really hard to close them. So they're starting to look down market, and perhaps deals like 5 to 10 million ARR. For example, we spoke to Google, and they're looking at deals in Europe in that size range. So it's interesting because that adds up to the competition. But yeah, generally agree, it's definitely a seller's market. In terms of the cycle, it's a really good time to sell.
That's great to hear. A year and a half ago when we started SaaSRise, there's still this sense of an overhang in the market compared to 2021 when there was low interest rates and a boom in valuations due to COVID. Now that's obviously come down versus 2021, but compared to most other usual times, when you look at the deal volume or the amount of deals that are getting done, it's way higher than any other time in the last 20 years, except for 2021 and 2022, that 18-month period that was very, truly extraordinary. So, Marcin, could you speak about what you're seeing in the market right now? And perhaps you could answer Chris's question that just came in. How long do you expect this seller's market cycle to last as well as what you're seeing currently?
Oh, that's a great question. I was actually excited to say something different, and perhaps maybe it's time to wait because the momentum is only getting stronger in the tech industry. And depending on what happens with interest rates and with the new US administration, perhaps towards the end of the year or even in 2026, the market might be even better. But obviously that's a riskier approach because valuations have taken off a little bit since 2024. And you can never time the market perfectly. My personal bet, we have good 4 to 6 quarters ahead of us when it will be a seller's market. But obviously, you have to make your own analysis and understand the risks involved because if something happens in the global economy, then it might be quite impactful because the leverage overall is huge. and therefore any instability can cause large turbulences.
Well, it sounds like we're generally unanimous that 2025 and hopefully 2026 are going to be good years to sell. The next two topics I want to talk about are multiples and then how to actually prepare for and execute a transaction. I'll leave this to anyone that wants to answer, and perhaps you'll have different perspectives because you do different things in the market. When is the right time based on ARR to consider using a marketplace versus using an M&A advisor? And perhaps someone or multiple people could explain your perceptions on what is the definition of an M&A marketplace and what's the definition of an M&A advisor? That would be my question for the group.
I mean,
I think
I generally, oh, go ahead.
Go ahead. No, go ahead, Khaled.
I generally, most of the time, advise against going and doing it on your own. A couple of reasons. It's almost a full-time job, unless the business is already very passive for you. Your advisors, depending on your size, should sometimes utilize a marketplace themselves. Again, it depends on the deal size. If you're under $1 million in ARR, maybe at that point you might want to self-represent because you've been running it for a while and you haven't broken that million mark. But if you're above $1 million, I would advise going with an advisor, and someone who's going to be able to deal with strategic outreach and using a platform or not, et cetera. That's sort of my take on whether to go with an advisor or not.
Perfect.
Yeah.
Go ahead.
I was going to say that probably the first question is whether you should sell at all. Because if your business is growing and there are chances that you're going to get to the next million of ARR, be it 2, 3, 5, or whatever, I think you might want to hold, because the more you grow, the higher the multiple you're going to get when you sell. But yeah, generally, I would raise that bar a little, perhaps to the 2 million mark. If you're about 2 million, I think it makes sense to go with a full-fledged advisory. Whereas below 2 million deals, you can get very good service from people like Flippa or Acquire.com that are doing a great job. It depends. Perhaps if the business deserves a high multiple and is growing and so on, it might make sense to also use that type of advisory. But
I agree with both Khaled and Juan, and also to add, a good M&A advisor would not only be used for kind of outreach purposes, where obviously based on our network, we can get to the key decision makers timely. But another important point is to prepare the company for an exit, which is as important as the outreach. So that's where I think an advisor differentiates from marketplaces, whereby a good M&A advisor would work with you for a couple of weeks, even months, to prepare your financials, metrics, positioning, synergy cases, etc., that justifies that premium multiple at the time of an exit.
I would add to that one thing, that marketplaces, because of their ease of use, they're a great testing ground, I would say, to just float the idea of selling, see how the market reacts, get some feedback. It doesn't require much professional services work, so the barrier to enter a marketplace is much less than engaging an investment banker. So if you would just want to test how much your company is worth and if it's sellable at all, I think it's a great idea to list it in one of these marketplaces and get some feedback, whether you decide to sell or not, and whether you then go on to engage an investment banker is a different story.
Fantastic. So I think the summary there is, if you're under 2 million in ARR, it might be good to use a marketplace like Acquire.com or Flippa. If you're at that range or getting close to that range, using an M&A advisor like the folks on the call here is probably the right thing for preparing for the optimal outcome. I want to talk about two more topics before we go into the questions. Feel free to keep putting your questions in the chat window, everyone. We'll get through all of them in the last 15, 20 minutes of this call. But the thing I want to talk about is what are the revenue multiples that you all are seeing in the marketplace, and then what are the key factors that can take a firm from getting a 3x, say, to say getting a 6x? What are the key things a company can do to optimize a revenue outcome, a revenue multiple outcome for them? Anyone here want to start?
So maybe I can kick off, and gents, feel free to chime in. So at ComCap, kind of we track something around 90 publicly traded kind of SaaS companies from different categories. And when we look at them kind of holistically, we call it kind of ComCap SaaS Index. We see the kind of revenue multiples on the median trading at around 7x for 2024, and 6x for the next 12 months estimates. How that although that doesn't necessarily one-to-one translate into kind of private M&A comps, and based on your ARR scale, multiples do differ. So someone trading 1 to 5 million of ARR trades different than 5 to 10 million ARR, and kind of I would say 1 million, 5 million, and 10 million being the key thresholds of scale premium that's get added to the multiple. Kind of we are seeing overall multiples anywhere from, on the low end, kind of 3 to 4x, all the way up to kind of like 10x plus, depending on strategy premium. I don't know. I'm interested in other people's views on this topic as well, in terms of what they're seeing.
I always like to caveat these with just growth, because I've also met with SaaS founders who are over the peak, and they're actually losing revenue month over month because they've been disrupted by one thing or another. And I'm sure we'll get to the discussion about AI agents and no code and things like that. But so the first thing I'll say is, if you're on a consistent upward trend, then these multiples apply to you. The second you are stagnant and or not growing, this part of the conversation doesn't necessarily apply to you. You need a valuation to understand what your multiple and value is. So I just always want to give that caveat, because I always get people say, well, I heard it's like 5x and I'm doing 10 million. And I go, what'd you do last year? We did 12 million. Oh, you're on a downward trend. That completely changes the game. I always like to give that caveat as well.
Yeah, I agree with that. I think that the three key metrics that we get asked about by buyers are, first of all, growth, second, net revenue retention, and then the third one, which is not exactly a metric, but it's about the product and how different it is, and how good the market fit is, and whether it's going to be disrupted or not. And if those three things are defensible, chances are you're going to get to the 10x ARR if your business is sizable enough. Otherwise, you're going to be in the 3x, 4x, 2x, that type of range. So yeah, that's what I'm seeing now. I'm talking about mostly 5 to 10 million ARR deals.
Yeah, and to comment on the 1 to 2 million, or even under a million, or all the way up to 5, you're looking at anywhere between 1 to maybe 3x ARR. I mean, I'm looking at about 150 transactions here on the monitor on my left, pulled from places like BizBuySell, which is a platform for traditional as well as digital businesses. Anytime they haven't broken $1 million in revenue, they're generally doing about 1 to 2x ARR. So I always like to let the smaller SaaS companies know where they're at. And like we've been saying in the conversation, when you break 2 to 5 and then 5 to 10, it becomes exceptionally easier to get higher valuations.
There is one more factor we are seeing, and it has huge impact on valuation, where you happen to be located as a business. So if you're fortunate enough to be in the US, or your biggest market is the US, then you get the highest valuation. But whenever you move to Europe, for instance, then you have to expect discounts ranging from 30 to 40%. And sometimes flipping the business to a US business can be a sensible thing to do, because then you get exposure to different types of acquirers. And it may make sense to work for a year or two in order to reincorporate in the US, maybe set up a team there in order to get this bump in valuation, which might be quite substantial. You may obviously get an American valuation being a European or Asian company, but it's not that obvious, especially on the lower end. On the higher end, I would say it's getting flatter, and the differences in valuations may not be that substantial. But especially if you're a smaller SaaS business, then this US angle has quite a bit of an impact.
And Marcin, how would you see the difference between a US company versus a Canadian company in terms of valuations?
Oh, Canadian and US, I would say maybe there's a slight discount for Canadian companies. Our data, but the sample for Canada isn't big. It's not conclusive. So I would consider this a single market.
And when you say a U.S. company, does that what matters most? Where the company is incorporated, where the team is located, or where the customers are?
So all three are a factor, and all three consider to contribute to what I would consider a U.S. company. So if the leadership team, at least, and it's a great deal actually, if your leadership team is in the US and your delivery or software development is in a low-cost location, that's even better probably for your valuation. But so leadership in the US, incorporation, ideally, and IP, especially if you're from a country that has some political risk, and there are a lot these days that have considerable political risk. And I mean, the hardest thing to change is the revenue structure. I mean, I wouldn't bother if all my business was in Europe. I wouldn't bother to flip the company to the US. But if at least 30-40% of my clients of my business was from the US, I think it's worthwhile to consider it.
Yeah, I echo to Marcin's view here. I guess one of the top requests when we start discussing with any potential buyer about a SaaS company is, okay, give us the SaaS breakdown by geography, by sector, by top customer base. And, obviously they want to not see any concentration, and kind of they want to see North America, including Canada, revenues contributing significantly, if especially the buyers in the US.
I will comment the U.S. corporation from my perspective, it generally is weighed the heaviest, because depending on the buyer, if they don't have access to cash, there is going to be a leveraged buyout. And if they're a U.S. buyer, they generally want U.S. financials and U.S. taxes to execute that leveraged buyout in the United States. So if I had to pick one of those three, it would be being incorporated in the United States, followed by U.S. customers, followed by U.S. management team. Because if we have the first and not the second two, I'll have an easier time selling that than if the other two are available but not the first.
So I want to go into the topic of how to increase your revenue multiple and how to get a better transaction value. Let's say you want to sell your company 12 to 18 months from now. What are the things you could do now over the next year to prepare to have a really successful high multiple outcome in 2026?
The list is long. Clean financials. I mean, I'll start with that. That's generally the obvious one, but I'm always surprised when I look under the hood of businesses. Are they recognizing unearned revenue, deferred revenue correctly? Are they have best practices for COGS versus not COGS, things like that? Is always just the first one. Like get those financials cleaned up and accountant reviewed. It's pretty important.
Yeah. I agree with that. I think ultimately, if you want to sell your business, perhaps there's not much that you should do in terms of managing the business differently. I think you should just, you know where your market is, you know where your customers are, you know what the product roadmap is. You should continue doing what you're doing, because you might or might not sell. And if you do weird things, chances are you get asked why you're increasing your marketing budget, or you might end up doing something that is not sustainable and you get adjustments. What you want to do is mostly reduce the risk of not selling. And if you want to reduce that risk rather than increase the multiple, then obviously you have to be very tidy with your financials, as Khaled said, and also be tidy in the way you manage your business. Be clean and do things right. That's generally the advice.
Yeah, I mean, there's a checklist too, and I have a like a paper I can give to anybody that's interested, including COGS and P&L, chart of account best practices. We recently had a client who we're doing value enhancement for, who is recategorizing their entire COGS or chart of accounts to SaaS best practices. But it is really a long list that starts with clean financials, because those are the things that you're measuring against. And then once you have that, you start to go through customer concentration, commodity versus differentiation of the product, GRR and NRR. Net retention is really important, because what that signals to a buyer is that you're expanding your current clients and they're not leaving. I mean, so it sort of looks at churn and expansion at the same time. And as we all know, there's a couple leaders in the space of information in the SaaS space, and the recent papers show that about 25% of, I think, CEOs don't track NRR. So have a SaaS metrics platform in place. I mean, even if you're doing it manually, which I don't suggest, there's things like ChartMogul and things that get bigger than that. You should be able to understand your MRR, NRR, GR, all the KPIs within a couple of clicks. If you don't have that set up yet, it's worth spending a few $100 to make sure that that's in alignment besides your P&L itself.
Yeah, and my point to that, by the way, Khaled, is that all that is good advice, regardless of whether you're selling or not. That's something that you need to do when you run a SaaS business.
Yeah, I wrote an article with one of my writers that says the path to an exit is similar to a path of a good company. So whether you're selling or just growing a good company, there are some divergence, right? So if I'm about to sell, I might not spend as much on R&D to increase EBITDA, to show a higher, gross profit margin rate. If I'm not selling, I might be a little bit more risk tolerant on spending on R&D. So there are some differences when you're diverging on the path to an exit versus growing or health. But for the most part, they are actually very, very common in that path. They have more commonalities than differences. And that's why it's good to engage with an advisor, because we could tell you, if you're going to make this decision, is this going to help your bottom line or your growth, right? So best example is like, okay, I want my EBITDA to be high, my margin, but it's wrapped around me quite a bit, and the next hire is going to cost me about 200,000. That's going to hurt my profit margin, but that's going to increase your multiple potentially quite significantly, maybe even a whole multiple, right? Depending on the hire itself. So these are the type of analysis you can do with an advisor to say, even though we're going to lose 200K in profit, we're going to gain a full multiple, and so the valuation is increased, and it helps with growth. So sometimes they're aligned, sometimes they're not.
Yeah, I would say, like there are three main categories when I start thinking about potential exit in the next 18, 24 months, like preparing financially, which Khaled and Juan talked, that's very important. Second one is preparing operationally, making sure you have a data room, and, we do have a kind of a level 1 data room list that I'm more than happy to share with anyone who's interested in it. Preparing a well-prepared data room that's buttoned up so that there are no, blind spots later on in a process. Making sure you have kind of the key missing roles hired already in advance of a process, especially a good kind of a CFO or a fractional CFO or a QOE getting done that validates the numbers, not just kind of quick and dirty numbers depending on your scale. Your legal requirements, compliance, all the taxes, etc. They all need to be in advance well thought through. So engaging with a good, M&A law firm and good kind of tax firm is all important. And then finally, pre-marketing. I mean, you can never be too late on starting to increase your presence among key decision makers, whether it's corp dev and M&A partnership individuals from strategics or kind of private equity firms, kind of partners and investment professionals. That's very important to start early on, as we are seeing deal cycles got longer and will continue to be long in 2025. We expect them to be about kind of 9 to 12 months, as opposed to in the past, we've been seeing kind of less than 6 months deal cycles. So it's never too late to start pre-marketing your business.
Speaking of the deal cycles, what we have found also is that the accuracy of financial projections is important, because once you start talking to buyers, quite a bit of time will lapse until you sell finally. And first of all, they will verify you on what you promised to deliver. So failing to do that is going to be an issue. But at the same time, under-promising is going to be, will lead to leaving money on the table, because if you end up exceeding your financial projections or surprising positively, it's really hard to re-enter the price negotiation. So you may end up leaving a ton of money on the table once the price has been set for a particular asset.
So I'm going to ask one last question here, and then we'll go into the questions from the group. You know, I'll make one comment and ask a question. So the comment I want to make is, in terms of valuations, as everyone's talking through today, it's all about your forecast. It's all about the present value of future cash flows. For anyone that's been through an MBA program, it comes down to a discounted cash flow analysis of what your future revenues and future profits are going to be in a likely scenario. And the reason why there's a huge difference in multiple between a firm growing at 30% versus a firm growing at 60% is that that gets compounded over multiple years. And a firm that's growing at 30%, that's 5 million today, might only get to 10 million, 5 years from now. But a firm that's growing at 60% that is at the same, 5 million ARR might get to 20 or 25 million 5 years from now. And so it impacts a lot. And ultimately, the value of a company comes down to the present value of future expected cash flows. And these multiples for EBITDA and revenue, we're just trying to estimate that. The last thing I'll say is look at what your rule of 40 number is for your own company. Rule of 40 is simply you take your net profit percentage and then you add together your annual year-over-year growth. And so if you had 20% annual growth and 10% net profit, then that would be your rule of 30 company. And what we found is that the firms that are at that 40% and higher, where your net profit plus your annualized revenue growth is at least 40% in aggregate, are the ones that can get these median valuations or better. So those are my big comments. The last question I'll ask for the group is, let's say that you're ready to hire an M&A advisor and you're ready to start a sale process here in the first half of 2025. For people that are going through this process for the first time, what is, explain to the 47 attendees we have right now, what does a sale process look like? How long does it take normally? And how do you optimize a good result for these companies as they sell if you're the M&A advisor for them? What are the key things you need to do? Khaled?
Yeah, so I'll go first. It could, I always put it as a sliding scale. I'll speak frankly here. The first thing is the seller's expectations. If there's a gap between the market value and the seller's expectations, that's generally going to delay the process quite significantly. So let's just assume that the seller's expectations is within the market value, right? We say, look, this is what we think we can get. And they go, great, I'm willing to take that. Because there tends to be some survivorship bias where they say, oh, this is what somebody else got. We go, well, we have to compare it to what you are. Assuming that's the case, it could be, if it's a healthy company and it's priced correctly, as fast as 6 months. 6 months meaning from the second, assuming the company is healthy and needs no additional value enhancement. So your financials are clean. There's no legal, gray clouds over it or anything like that. Going to market, vetting, LOIs and signing. And again, that's quite aggressive. 6 months is quite aggressive. I've seen them take as long as 12 to 14 months, even longer, 2 years, because something was under LOI for 3-4 months and that fell through, and then we had to go back to market or whatever the case may be. So it is a wide range, and it slides based off the aggressiveness of the enterprise value or the asking price. So if you're priced really high because you just have that anchor, it's going to take a lot longer because you've shrunk your buyer pool to a smaller group of people. But if you let's say you're worth about 5x and you list it for 4.5, I know that sounds a little bit unorthodox, but you're actually going to potentially get that 5 or 5.5 because you're going to create demand that way. So that's, it depends on the business. I wish the answer was black and white, but it's very nuanced.
I would break the kind of the engagement and the process into different buckets. The first bucket is preparing, and we control the preparation time. We can go as fast as a couple of days if the company is well prepared already with marketing materials and financial documentation, forecast, data room, etc. If everything is ready, it's a matter of days, but it can take up to kind of weeks or months, depending on kind of how ready the business is based on our initial assessment. And then we go into formal marketing, meaning us picking up the phone and reaching out on your behalf to potential parties and getting calls scheduled to discuss with them about the opportunity, about the company, highlighting the synergies, highlighting the business, answering their questions. That kind of marketing phase take anywhere from a couple of months to longer. And then we do schedule in-person or over Zoom meetings with you. That's called kind of a management meeting. They will want to meet the management. They will want to meet the founder. They will want to learn the story and ask their questions. So we go into that roadshow, and then we would have a bid deadline. If we are running a proactive sale process with a bid deadline, we will funnel all those parties to submit their bids in and around a similar date, so we can make an apples-to-apples comparison and consider all of your options in one place. And then once the offers are ready, that we start negotiating those offers, and then go into what I call due diligence phase with one that we sign an LOI, typically gets into an exclusivity. But there are occasions where we were able to kind of get two lead horses into due diligence. Obviously, they tend to not want to do that because they commit resources and budget to do that due diligence. And one party would not want to do that unless they're in exclusive discussions with you. And then comes the kind of closing phase where kind of the merger document, the SPA negotiation starts, where an experienced kind of legal counsel can also come in handy at that stage. So I agree with Khaled, like 6 months would be an aggressive case. I would estimate 9 to 12 months being kind of somewhat more normalized in 2025.
I would look at our job. Sorry.
Go ahead, after you.
I would look at our job a bit from a different angle and more from a human perspective, because essentially as a founder, most likely you'll be doing it for the first time. So it's good to have someone in your corner when you're negotiating, dealing with people who've done tens or hundreds of deals. And also it takes an emotional toll, this whole M&A process. And having an M&A advisor as a buffer takes a lot of this emotion away. Things may be proceeding a bit more slowly because you're not talking directly to a buyer, for instance, but ultimately it goes faster because we put structure and deadlines and we can enforce them, because to us it's not that personal. It's not. It's a profession that we do, a professional engagement. And the other thing is that it's a big life decision, and we often find ourselves to be working with people as kind of a coach, psychologist, and ultimately as a trusted friend, because selling a business touches a lot of things in life that are not necessarily financial or professional, because eventually, once you sell, you have to reinvent yourself a little bit and transition to a new stage of life. So we see our clients go through different emotional phases in the M&A process, and we help them ride this roller coaster, because you may get a little bit excited at first. You get all of the attention and recognition from people who are would-be buyers, and they see you in value in your business, which is great, which is a great ego boost. But then when it gets real, you realize that it's going to be something new, and then there's uncertainty, and you have to deal with that. There's also anxieties of the team because, and you have to handle that, manage that, because if you're a founder, transitioning may be great for you, transitioning out, freeing up your time, but for the team, it's a huge risk, and you will need to handle a lot of their motivational issues before the deal. During the due diligence process, which takes a toll, it's time consuming and takes them away from their family life. So and then lastly, the whole succession process happens, and you have to be prepared. You have to prepare your team for that. So there's beyond the facade of investment bankers being numbers guys, finance professionals. There's a huge work that we do that you don't even realize when you engage an investment banker. But I would hope clients appreciate once they've been through this journey.
Yeah, I think a lot of the questions are, would you hire them? If there's 2 to 3, what factors are you looking at? I can't agree with more with what you said. I mean, you need to have a connection with that person. So just trust your intuition when you're selecting them. Obviously, look at pricing, retainer, talk to previous clients, their reputation, etc. But some of it is just intuitive. Does it feel like that person has your best interest at heart? Are they communicating the way you prefer to communicate? Some people like it to be, cheap and quick. Some people like it to be deep and, highest quality. It's going to be a representation of what you like. And they are going to be almost a friend and if not become a friend, because again, you're dealing with potentially tens of millions of dollars, and they're going to be the ones that have to negotiate on your behalf. The last thing you want to do is negotiate with a buyer directly when now you have to maybe stick around for an earnout for 2 years, when at one point it got really heated during the negotiation on something like reps and warranties or holdbacks or something like that. And so it is, the advisor IB's job to take those arrows on your behalf. They will be the bad guy when they need to be. That should not be the owner of the business. That's what I see most commonly, is that they think, well, I can do this, and it's like you're gonna go through battle, and then you're gonna have to go through another battle, which is now potentially transitioning the business and making sure that your team is motivated to do that. I would say the emotional toll that we take on your behalf is generally undervalued.
Juan, it looked like you had something you wanted to add, Juan.
No, totally. I mean, I agree with everything that was said here. I would say that it's interesting because the first question that we ask our potential customers is, do you really want to sell? People come to us and they say, well, I'm thinking whether I should sell, maybe I shouldn't. And I tell them, look, you've been working in this business for like 10 years, it's growing, it's healthy, why would you sell now? Then we tell them about multiples and the market cycle and so on, so that they can make that decision. But ultimately, if the business is going well, when you sell it, first of all, you're gonna go through a lot, and second, you will have to find something else to do. And ultimately, the question might be answered with, yes, I want to sell because I really want to move on, and that's probably the ultimate factor why people decide to sell and engage through that process. But that's probably the first question that you should ask yourself. And then the good thing about working with an advisor is that obviously you will have to spend time as a founder providing info and answering questions and so on, but it's mostly passive. There's a guy that's holding your hand and who has an incentive obviously for making it to the finish line, and who's going to be negotiating and doing everything on your behalf. And so it's mostly passive. So you can set the pace, you can decide how fast you can go. And as much as this advisor can do, they will do on your behalf.
So we've got 10 minutes left, everybody. We're going to put the emails for all 4 of these panelists in the chat window now, so you have them. Feel free to reach out to them with any questions that we don't finish up and get to here, and for the resources and valuation estimates they've offered. Let's go to the questions. I'm just going to have time to only select a couple handful of questions here. I'm going to take what I arbitrarily consider to be the most relevant questions for the largest group of people here. So Ewan had a question from emissary.ai. He asks, what growth rates do you need to see, annualized revenue growth rates, to maximize the chances of a successful transaction? What do you all see as sort of the minimum annual revenue growth rate you need to be able to get a good or above average multiple on a transaction done?
I mean, we saw businesses sell even if they were flat or growing 0 to 5%. That's not ideal, obviously. Anywhere north of 20 to 30% will land you a good valuation. If it's a bootstrap profitable business, that's perfectly good.
I would probably add to that as EBITDA margins. So a business growing 20% while being 20% EBITDA margins, so rule of 40 comes into play, is different than a company growing at 40%, but kind of negative 20% EBITDA margins. So yeah, yes, growth is more appreciated in the market than the EBITDA margin, but today's buyers are looking at rule of 40 more than just growth rates.
Yeah, 20 or more growth rate and 10 or more profit. If you're above that, you're generally going to, from the charts I'm looking at.
Right, and then we got a good question related to that. Does profitability matter for a SaaS company sale? Obviously, it's nuanced, but what's your perspective on that question?
I would say it makes you safe, because if you don't have too much burn, you don't need to sell in the nearest future. So it's always good to stay positive from risk management perspective. But it's not mandatory, and especially if you can grow fast, it's better to sacrifice some profitability to grow faster. And the value tends to compound very quickly if you're growing 50 to 100%. It's mind-blowing how quickly the valuation increases.
Yeah, I think profitability also opens up the universe of potential buyers, because some buyers won't look at businesses that are unprofitable. So yeah, I think it helps.
Yeah, if you're growing at 50, 60, 70%, you might not need to be profitable. But if you're growing at 10, 20% a year, having certainly EBITDA profitability is important if you're going to be able to sell at an average valuation. Okay, I'm going to just quickly look through if there's any other questions while I do that. Okay, Okan, if you want to add on to that.
Yeah, no, I agree with you, Ryan. Like, if you are, and that hand raise was a mistake, but that if you're growing definitely less than 20%, focusing on how you can do that more profitably, and focusing on profits as opposed to top line might be a good idea if you're planning an exit in the next 18-24 months.
Yeah.
I just want to comment, I think a lot of that comes from the SaaS, from the VC space that kind of over leverage growth only. And so we're seeing that correction start to hold profit to be sort of a strong indicator of the health of the business, not just revenue. That's why that generally is occurring now.
I'll throw in a quick data. So of that ComCap SaaS index, we track 90 public companies on a rule of 40 scale. The ones that are kind of less than 20% on a rule of 40, they trade at around 4x. And the ones that are 60 plus, they trade at 17x their revenue. So there's this huge improvement, and that's kind of across the board. As you improve your rule of 40, your valuation typically gets improved.
What I think will be the last question for today is, what are the key factors in selecting an M&A advisor? How would you all advise the group here on selecting and finding the right M&A advisors for them?
Well, I think I love what Khaled said about intuitive selection. In the end, you have to make sure that you empathize with the person. I think that's important. Obviously, you have to work with a firm that will know your space and know your industry. And for that, you have to look at their credentials and their personal track record. And I guess that sometimes it goes both ways, that the firm will decide who to work with and who doesn't really make sense, because you don't want to take a mandate that you don't know about and you can't help, because that's a waste of time for everybody. So they will help you also choose.
Yeah, I would say, having intro calls and meetings with at least a handful of advisors is a good idea. If I were a founder, I would want to know different banks and different advisors and try to understand kind of their engagement style and kind of look at their credentials, track record, to better understand who would do the best job for me. And there's the personal aspect, as Khaled highlighted. Obviously, this is a kind of a partnership, and so it's really important that the person you choose to advise you on, you can consider him to be, quote unquote, a friend that you can call up in the middle of the night with your questions and concerns, or and they will be there for you to address those.
Yeah, I think the thing that we compare it to the most as humans, like what's the other biggest transaction you do in your life? It's like buying a home. So like a lot of people come to this and go, okay, this is going to be a transaction. It's going to sit in escrow for 60, 90 days, whatever it may be. And then the transaction is going to be done. But it's quite significantly much more emotional than that. I would even argue that it's much more emotional than it is technical. There's going to be LOIs you get excited about. There's going to be times where something might happen to the company as you're trying to sell it. It is literally, I would compare it closer to a marriage than I would the purchase of a home. And so when you're going to marry somebody, you want to date them for a little bit. So having a couple of meetings, even with that advisor, to understand how they interact and talk to you, I would do that. And so that's why when I say trust your intuition, because at the end of the day, you're going to choose advisors who have some experience. They're all going to be comparable in, fees, maybe slight variance there. The biggest difference is generally going to be how you feel about them. And if you do not have a positive feeling about them from the beginning, you will not be able to go to battle correctly. So I very much compare it to a pretty strong battle. I tend to weigh the emotion a lot heavier than I do the quantitative side of things, but that's just my style, because the way I've been through it has just been a lot more emotional than most, I think.
I would also say that you should pick an advisor for whom your business is the right size. So you might be tempted by big brands and bulge brackets to and pick a bank that has a lot of tombstones. But if you're one of 50 or 100 projects they're running in parallel, then you might not get the best service. At the same time, when your business is substantial and you go with a super small company that doesn't have the necessary resources, you risk leaving money on the table because they won't be able to match the needs of your project, of your deal. So I'd say right sizing and doing your due diligence on the portfolio of the firm that you consider engaging makes a lot of sense, because you want to be confident that they take you seriously and you're not one of many clients that they will put through a very standardized process and basically not care too much.
And along the same lines, I agree with Marcin. Getting to know not just the deal lead, which could be any one of us here on the line, or 4 of us, but the broader team that's going to be working on your project, and getting to know them is also equally important. So I would advise, at some point before the engagement, getting a grasp of the full deal team is important.
Wonderful. Well, we're going to wrap up here. I put everyone's email in the chat window, and please feel free to save those before the meeting ends. We're going to follow up in a couple hours with the recording, as well as any resources that the panelists want to forward to us that we can send around. I thought this has been a very productive discussion. For me, I think the value of paying that 3 to 5% or whatever it is to an M&A advisor is simply that they're going to help you emotionally get through a most challenging sale of your life, most likely, or one of the top 3 big events of your life. Number 2, they're going to run a tight process, make sure you get multiple offers. and they're going to ultimately increase the valuation and increase the likelihood of a successful deal happening. So I'm a big fan of it, and I think they're worth their weight in gold. Thank you guys, all four of you, for being here today. Okan, Khaled, Juan, Marcin, it's been a pleasure. We'll be having another webinar next Tuesday at the same time for firms in the 10 million to 100 million ARR range. Feel free to join that as well. And we'll be in touch with all the attendees here in a few hours with the recording. Thank you all for being here today, and have a wonderful rest.
Thank you very much.
Thank you, everyone.
Thank you. Cheers. Bye.
Cheers. Take care of everybody. Bye.